Rising market borrowing rates have taken a toll on housing finance companies. Stocks have seen a significant correction from the recent highs as well. But is this just a story of costs, or is there risk of faltering growth in a sector that, well, at least until last year was touted as a multi-bagger, was touted as a safe haven for lenders as well? Shraddha, Babla is standing by with a closer look at their financials and what could be impacting them in the near to the medium term. Shraddha, good morning.
Good morning, Neeraj. So I'm going to start off with actually showing you the kind of share price performance trends that we have seen for housing finance companies. So in fact, while in FY or calendar year 2017, we saw double-digit returns, in fact, in excess of 50% for most of the housing finance companies, barring LIC Housing Finance. In 2018, so far, those double-digit gains have only turned into double-digit losses for most of them. In fact, if you also look at the change from the 52-week high, you can see that most of these housing finance companies have seen sizable correction. So what is the reason and what are the concerns which are plaguing this sector at this point in time? Well, the first and the most important one probably is the sharp rise that we have seen in the market borrowing rate. So if you actually look at this picture, the blue line is the white line, sorry, is the 6-month commercial paper rate for NBFCs. Now, after a significant rise in in 2017 and 2018 also, they have gone up by about 75 basis points. Now, why are these yields are very important for housing finance companies? Let me tell you that housing finance companies, this will increase the cost of funds for them, of course, but given the current scenario where competition in the sector is at its peak, housing finance companies don't really have the pricing power to pass on the entire rise in the cost of funds. So that can actually lead to compression in spreads for some of these companies. That's one of the biggest reasons or worries for them. If you see who could be hit the most, LIC Housing Finance, of course, with a larger share of market borrowing, but not just LIC Housing Finance, even the likes of PNB Housing Finance or Canfin Homes had made significant short-term borrowings from the market last year. All of them will mature this year and will come up for refinancing, which they will have to do at much higher rates because the interest rates in the system have gone up. So that will lead to a higher cost of funds and a big compression in their margins. So that's one of the biggest reasons for the negative sentiment as far as housing finance companies are concerned. That apart, let's look also at the growth prospects. Now, if you look at the FY18 loan book growth for most of the companies, they do look like reasonable numbers. Just for example, let's pick up the case of LIC Housing Finance, 15% growth in FY18. While this may look like a decent number, if you break it up, the growth in the individual home loans was only 10%. The remaining 5% growth has come from, LAP, that is your mortgage and builder or developer segment. So the worry here from analysts is that in FY19, you might not see this kind of support that we saw from the mortgage and the builder loan segments, especially this builder loan developer / construction finance segments, because real estate sales have not really picked up, especially in the larger and important markets in India like Mumbai or even Delhi, Gurgaon, Noida. So that's one concern, because of which they believe that loan growth book rates in this financial year could be lower for housing finance companies. Secondly, the much anticipated pickup in affordable housing finance loans is also said to be a few quarters away because we haven't really seen affordable housing projects pick up the way one would have expected to. So there is not enough supply at this point in time for demand for finance. And thirdly, the competition is at its peak. You have new entrants like Aditya Birla Housing, Piramal Housing. You have Bajaj, which is Bajaj Finance, which is entered into housing right now. And not only that, even smaller PSU banks, not just larger, but even smaller PSU banks are very active in this space, even, lending at low margins, because this is probably the only area that they can lend to. What about the asset quality aspect? Well, while the absolute gross NPA percentage may not really seem very high for housing finance companies because most of them are sub 1%, if you actually look at the trend, however, that's actually, you've seen gross NPAs rise for all asset finance companies, barring only Indiabulls Housing Finance. So this is the basis points increase in GNPAs for FY18. So the trend has been that of deterioration. More importantly, the concern here is that, or the belief is that that while LAP segment loans could have peaked out in FY18, analysts actually are worried that the builder loans NPAs have not probably reflected, and affordable housing players are also saddled with about 3 to 7% sort of NPAs. So those are another point of concerns as far as housing finance.
So that's very comprehensive, Shraddha. Very quickly, how do the valuations stack up?
Okay, for that also, let's just look at the price to book value and the current valuation picture. So if you compare the current price to book value ratio of the housing finance companies with their 5-year average, you will see that most of these companies, again barring LIC Housing Finance, are actually trading at or above their 5-year historical average, which means that the recent correction has not really made them really attractive. That's probably because the growth estimates have also been revised downwards. So analysts believe that all these concerns which are there are not going to disappear anytime soon, and hence they have a neutral rating on the stock. They've said that it's time to be extremely selective on some of these companies. So we just put up some data from Bloomberg and try to see the consensus rating on what the best picks for housing finance companies for analysts right now are, with a rating of about 1 indicates a sell and 5 a buy. So you actually have HDFC and HDFC is one of them, HDFC, and then you also have Diwan Housing. Both have a consensus rating of 4.6 and 4.5. So that's what the Bloomberg data throws up.